of the day that I choose, and I knew who was coming on the panel this morning, and I thought, I've got to cover this. TechnologyOne. Full year revenue increased to 18% to $369 million in an update this morning. Full year profit after tax up 22% to 89 million. Remember, this is a tech stock, and annual recurring revenue rose 25%. Expenses expected to fall next year because of synergies with Scientia was realised. Business expects margin growth to continue next financial year. Over the coming years, it expects a 35% increase in margins, wow, a special dividend of 2 cents a share to a final dividend of 10.8 cents a share. Let's see how it's performing, up 4% today after that announcement. Now, it's a bit of a toss-up between who is the number one fanboy for TechnologyOne, but I think by a narrow margin, it must go to Rudy. Rudy, what do you think of it? You've, for years, ever since we've been doing the call, you've said this is your number one stock, yes, on the share market.
To keep in your portfolio.
Yep.
May I make a suggestion? When you have Mark and me on and you pick TechnologyOne, I think you should play some music from the background. My suggestion would be the theme music of the A-Team.
All right, we will do that next time. All right.
But if there is one...
In fact, yes, that'll be a bit of fun between now and the end of the year. Jared, who drives the show, we need theme music, appropriate theme music for each of the panels, I think, is the introduction.
And I'm pretty certain that both Mark and I are more than happy to take a big cigar and we go, we love it when the plan comes together. And that is usually what happens when TechnologyOne reports results, yes. Yeah. Right? I mean, a lot of investors, they constantly want the next big thing. And in technology, there are many more companies that at face value offer much more exciting technology. I mean, WiseTech, Altium, Xero, they often get analysts excited, even the likes of Live 360 and
Hub24.
Hub24, for example. TechnologyOne at face value is actually quite boring from a technology perspective. I mean, Morgan Stanley recently issued a report on the local technology sector, and they basically described the software that TechnologyOne sells to its customers as nothing special. And a lot of the other companies, of course, they have much more exciting. But if you go down to the basics, and since 2004, we had a little bit of a NASDAQ fallout in the years before that. But since 2004, this company has basically grown double digits in pretty much every year, maybe with the exception of one, I believe, when they only did 7%. Ooh, only 7. Last time I did the calculations, over 10 years, the return was 1,100%.
Yep.
Where do you actually, apart from the fact that this is simply, apparently, non-exciting as a technology company, but has a churn of less than 1% and has double-digit growth every single year, you can only discuss, I think, about the share price, right, and the valuation. As far as I'm concerned, I mean, maybe you don't want to chase it when on a day like today, when it's obviously on the up. Usually what happens is that once the result is out, some profit taking kicks in, and often the weakness can be 5, 6, maybe even 10% sometimes. Right. Maybe that's when you just have to pick your level, essentially. It's a bit like Pro Medicus. I mean, everyone always goes like, it's a high valuation, yes, but it always performs. And those stocks, they never trade on single-digit EPs. I mean, you're way too late. 2004 would be the day to achieve that. So now you just have to pick your level. So I think this is a solid hold.
Right.
And I would, if there is a stock that you can confidently say, I put in the bottom drawer of my portfolio,
this is it.
I challenge anyone else to come up with a better one.
Okay, so you've been in it a long time, so yes, you've done well out of it. $12. Yes. You're saying if it pulls back to, say, 10?
Oh, definitely.
Right.
But the question now is, will it now pull back to 10?
Well, this year, it
has been there
around that 10. Mark, what's your view?
Well, T&E's been one of our best wealth winners at Team Invest. I've been a shareholder for 13 years.
Yep.
And I've done extraordinarily well on it.
So
My
you've
only
done your
mistake
1000%. You've done your 1000%.
I've done more than 1000%.
Yeah.
And it's the mistake I made was not putting more money in where we had opportunities where the share price was quite low. Now there was it went down to 470. I could give you some. It's quite amazing how when there's a market drop, everything comes down.
Jared, can we bring up the 5-year chart again? Let's. There we go.
That's it, yeah. But so if you look, that's 5 years, and over 10 years, there was a short seller report a couple of years ago, and it came down to $7.61. I remember.
Right.
I did buy a few.
That was 2019, I
should have
believe,
bought more.
2020.
Anyway,
Exactly.
But just talk about the
You can
business for
see
a
that
second.
drop down
I think,
there.
well, the good thing about T&E is what it does is it epitomises what we class as an outstanding business. It was founder-led with Adrian DeMarco, very conservative. So what he did is he designed a brilliant business concept for being a reliable growth business. This is the problem. When people look at technologies, and I totally agree with what Rudy said, that T&E's technology is nothing special. Basically, it's enterprise management software, but they were smart in going for a couple of very defined verticals. So they went for councils. So they're the major supplier for councils in Australia. Is the biggest area. They do a lot in education, Catholic schools and so on. Very specific. So what they did is they developed their technology to solve their problems specifically. And others were general, like SAP. SAP's their biggest competitor with councils, but that's like a massive program, costs a fortune, complex, and all the rest of it. So what T&E did is they got into the councils and they have what's called a trapdoor moat. Once you're in, you can't get out. We love trapdoor moats. Moats are good. Goes to sustainability of earnings. A trapdoor moat means that the cost of moving is so great no one ever moves.
Right.
So if you're a council and I've got a fully integrated T&E system which everything's on that payroll, managing approvals, everything, how easy is it to change it? It's just about impossible. Without having a year program and cost a fortune. So it's got and what that does is it goes to, and then the model, the way they charge, it's charged on a per seat basis and so on. It has an inflation increase automatically built in. Plus the fees increase every year because they're updating it.
Right.
So as they add new clients, and it's the same as PME, so it's exactly the same model. It's a great model. And it's been very conservatively run, no debt, and they obviously deliver a good experience with their clients. They've now expanded into the UK, and that's now in a profitable area. They did it the hard way. They didn't go and buy a business like most companies do. They sent Aussies over, hung up a shingle, banged on the doors, and now have 19, last I checked, councils in Greater London, and they're doing the same thing in the UK than here. And then eventually they'll probably do the US the same way. Slow and steady, from our point of view, gives us these spectacular returns. Now, just talking about price now, I'll just finish off because I could rabbit on all day, obviously.
Yeah, well, we know. I was about to say, can we look at some of the other Hang on, you're just as bad. You jammed him into a corner.
I'm disappointed about the price going up as much as it has, because I have had an order in at $7 for a while. It might have expired by now, I'm not sure, but it's just slowly gone away. But it's on a 51 PE at the moment. Its EPS growth rate's running at something like 15 now. I don't have to rework it out with the latest numbers. 15, it's gone up, which is fantastic. It's a very heavy PE for a fantastic business. But the PE is in the red, which means in the top quartile of its range. So it's always T&E's had a high PE for the last 6 or 7 years. So it's expensive on that metric. To get into the bottom quartile is where we like buying it, is $9.93, which comes back to Rudy when he was saying $10 is a good price. And it'll go there, I think. It probably, because we'll have some sort of market space. I don't think T&E will do anything that'll cause it.
Let's just hope for both of us that none of the international players get some ideas and buys it or tries to buy it.
Well, they'd buy it and we'd get a big payout, but it'd be very disappointing.
Well, exactly.
It would be very disappointing.
Because it's a one-off. And,
So you're both saying so many people on the expert panels, our analysts have been saying, even though it's a Santa rally at the moment, there's going to be another leg down next year. Don't get too carried away with how the market's done. This is at the top of your list for when the crunch comes next year.
Well, I've often said that I think T&E's arguably the best company on the ASX.
Right.
Because you can come up with a case for that.
It is definitely the most consistent one.
Right. Okay. All right. So put it on your list if it gets to $10.
So it's a hold
or below. Good solid
strong hold.
All right. Lindsay wants a view. There are, surprise, listening to these two, you would think maybe there's no other stocks on the share market, but there are. Lindsay wants a view, Mark, on EBOS Group, the pharmaceutical wholesaler and distributor in Australia and New Zealand. What do you think of EBOS?
Not much. It's not bad. The pharmaceutical area is very tough. It's very, very competitive, and it seems very difficult to make any sort of decent returns on it. It fails on return on capital for us at 7%. We have a minimum of 10. So it's okay. If I look at it, the current PE is 28, and on its EPS growth rate over the last 6 years has averaged 8.8, which is not bad, with high stability. So it's not a bad business at all.